Okay, I will go ahead and get started with the opening. So good morning. Welcome to Maynard Costerison's Nonprofit Education Series for July. What's new with nonprofits? We will be diving into the tax and audit insights gathered at a recent national conference, and we are so happy to have you here. Few housekeeping items. The session is being recorded, and everyone is muted. If you do have questions, though, throughout the webinar, please type them in the chat function, and we will have time at the end after both presenters to be able to go through some of those questions that you might have. If we can't get to all the questions, then we will definitely follow up after. This session is giving CPE credit, and so attendees may be eligible for 1 hour of CPE credit. To qualify for the CPE, attendees must participate in at least 3 of the 4 attendance polls and attend the webinar for at least, oh, my practice one just came up. Sorry, excuse me. So Rebecca just said a practice one. Hopefully you got that. And you must attend for at least 50 minutes. This doesn't include that practice poll. If all the criteria are met, participants will receive an email with a link to their certificate, which will be issued via Prolera, which is our learning management system. If you have any CPE questions, please send an email to Rebecca, and her email will be in the chat field. Speaking today are Amber Rathbun and Jeff Strauss. Amber is a senior manager in our tax department and is active in our nonprofit niche leadership team. She provides compliance and consulting support to nonprofit clients so they can achieve their ultimate goals. And Amber is nearing 10 years with the firm. Jeff Strauss is a principal in our audit department and has over 17 years of experience serving nonprofit and education clients. Jeff is also an active member of our firm's education committee and serves as a finance director for a charter school district. We thank them both very much for their time today to share their endless knowledge with us. And with that, Amber, I will turn it over to you to start.
All right, I will start to share my screen. Try this again here. Let's see which slide. Helps if you hit the share button. So let's get this going here. Does that look good if someone could chime in?
Looks great.
Okay, perfect. So again, I'm Amber Rathbun, and I attended tax sessions at the recent AICPA nonprofit conference in DC. So this is going to be my agenda for today, and I'm going to be covering some state compliance considerations for charitable fundraising. I'm going to talk a little bit about accepting gifts and the donor acknowledgement letters. For foreign reporting, I'm going to touch specifically on Schedule F and FBAR. And then from a state regulator's perspective, I'll talk about top 10 things to avoid, and then wrap up with year in review, which will be some recent news, statistics, and resources. So just keep in mind throughout this that each of these topics were 50-minute or longer sessions over the 3-day conference. So I'm going to be hitting these at a really high level. Just want to raise awareness, get these things in the back of your mind so that you can dig in or maybe ask further questions later if you run into these things. So starting off with that charitable fundraising, state compliance. So this is a topic that I could talk to you about for 20 minutes straight. So I got to be careful here. I put it in the beginning, but most states do have registration and reporting requirements for charities, for professional fundraisers, consultants, commercial co-ventures. Michigan specifically does require reporting on professional fundraisers, not the consultants. And I will give a website in a couple of slides, but the forms and instructions and definitions of professional fundraiser versus consultant are all there on the website. When we're thinking of solicitation, it's really a broad definition covering a lot of things. It could be a text, a sign. It could be implied, a suggestion to donate, and it can be direct or indirect. I do want to throw out also this common misconception that I run into, and that is hearing, my charitable organization does not solicit, so I don't need to worry about filing anything with the Michigan Attorney General Charitable Office. That's not entirely true. So if the organization isn't soliciting, they may not need to file a registration or an annual renewal registration, but they do need to qualify for exemption, file for exemption, and get a Michigan file number. So that's going to be for specifically C3 organizations in Michigan. So that's formed in Michigan or having some sort of assets, including a bank account in Michigan. Now, with a lot of the exemptions, there may be a requirement to submit your Form 990 annually. So really want to make sure that you're following those Michigan, compliance pieces there. So keeping in mind too, other states are different, may not just be C3 organizations. It could be other 501c organizations or even for-profit organizations if they're soliciting on behalf of charitable organizations. So on the next slide, I'm going to go into, where should we be registering in? And we're going to be looking at where you're soliciting, where you're having fundraising events, and then talking about that, popular donate button on organizations' websites. So if you have a donate button on your website, that doesn't mean that you need to register in every single state. What we want to do is we want to follow, as a general guideline, the Charleston principles. And so we want to look at where is your primary place of business? Is it in Michigan? Probably need to register in Michigan. Where are you having solicitation, fundraising, events, activities? Where are you targeting donors? So you want to look at those states. And then you want to consider your internet solicitations, including that donate button. So for this, we want to look at where are you receiving substantial donations from, and then looking at quantity of donations regardless of amount. So overall, the states really generally agree that substantial is 25,000. So hitting that 25,000 threshold, probably need to start registering in those specific states where you're hitting that threshold, receiving donations from, and then looking at quantity of donations, which the states do not put out guidance about that. There's only 3 states, and those are Mississippi, Colorado, and Tennessee, and those quantity of donations are 25, 50, and 100. So as a general rule, you could maybe look at 50 as your quantity of donations, start registering in those states. Then I would just want to touch on disclosures. So Michigan does not have a specific requirement for this, but a lot of other states do. And so when you're mailing out solicitations to other states, you want to include disclosures for the states that you are actually registered in. And that includes a hyperlink or a footer on your website and making sure you have the exact wording required in each of those states that you are actually registered in. Okay, so at the bottom of this slide, you'll see you might want to jot down this website. That's the Michigan AG Charitable website where you can find the forms, instructions, other information. And so I just want to point out that Michigan is pretty laid back. There's no filing fees. There's no late filing penalties. There's a pretty lengthy extension. If you don't file, they pull the organization from the website. But as soon as you send in your documentation, they put you back up on the website. This is not the case for all states. Some states have filing fees. They have late penalties. If you miss a filing, you may have to go back and report information for several years. They have different due dates. They may have a 2-month extension. So you really want to be aware of the different state requirements because they're not all the same. And then also something to note, when we're looking at Michigan review or audited financial statement requirement, government grants are excluded. But I know, for example, Illinois, government grants are not excluded when looking at whether an audit is required. So you may not be, your organization may not be required to register in Michigan, or not register, but to have an audit. But maybe you have a fundraiser in Illinois, and because of their calculation, you need to have an audit for Illinois purposes. Okay, moving on to charitable giving. So I just want to touch briefly on these things. Number 1, the organization should have a gift acceptance policy. And then you also want to know your donors. If they're giving non-cash items, know why they want to, offload those items, why they want to give the property to the organization. don't want to have any surprises, expensive costs that come with receiving the donation. Really, the donor should be bearing the cost of those gifts. Specifically with crypto, just note if it's over 5,000, you need a qualified appraisal, and finding a qualified appraiser could be difficult. There's some strategy involved that can be involved with donated art. And then I just want to touch briefly on conservation easements. It was brought up a few times throughout the conference. There's an increased focus on these. And generally, the consensus I got was don't accept it if you're not a conservation organization. So I got a little distracted by the chat there. Sorry about that. Okay, partnership gifts. So I personally have not run into this scenario, but the presenters had a lot to say about it, and none of it was good. So I just want to throw out there, if you are thinking about giving an interest in a partnership to a charitable organization, think twice about it and ask about the consequences and tax implications of doing so before you move forward with that. Okay, moving on to those donor acknowledgement letters. So donor gives to a charity, thank you letter goes out, and if you refer to IRS publication 1771, this is a snip right from that publication, and it says what you should include or not include in that letter. And then it will give you example wording as well. So what I wanted to point out here, definitely if a donor gives cash, you need to state the amount of cash given. But if it's a non-cash item, really the charity should not be providing a value. Number one, it's the donor's responsibility to be getting these letters, and it's the donor's responsibility to be coming up with that fair market value. It's different if there's a quid pro quo situation. You do want to provide the fair market value of items given to the donor for receiving the gift. And that is including if it was an item that was no cost to the charitable organization. Still want to provide that fair market value. And then I did want to say that when we're thinking about contemporaneous written acknowledgement, contemporaneous means the earlier of when the donor files their tax return or when it's due, including extensions. I want to touch on, we got a CPE poll, looks like. Touch on Form 8282. The charitable organization should be filing this if they dispose of a gift within 3 years of receiving that. There's a couple exceptions for the lower value items, or if it's distributed for a charitable purpose. And this form does apply to the original and any, if there's a successor donee. So the gift didn't stay with the original donee. And then just throwing out there, these letters should not only be sent by publicly charitable donations, or public charities, but also by the private foundations. Let's see, that poll messed me up here. Okay, so for foreign considerations. Now there's a lot of different foreign potential forms that need to be filed. I just want to touch specifically on Schedule F and F bar. Those are the most common, I'd say, that we see. So with Schedule F, those are going to be related to activities conducted outside of the US, and this definition is right from the form instructions, and that's at any time during the tax year. So one item that we want to be looking at is a 10,000 threshold for revenue or expenses. And so if the charitable organization is receiving international donations, were there any expenses associated with getting those donations? Do we have employees or independent contractors working abroad, providing program service, activities, fundraising, anything like that? In general, was there travel abroad? And are there foreign investments? So then a lot of organizations also give out grants or assistance to other organizations or to individuals, maybe in the form of scholarships. So it's pretty straightforward that if a grant or assistance is given directly to a foreign organization or an individual outside of the US, that would be reported on Schedule F. But what you may not readily be thinking about is grants given to a domestic organization for an international purpose, or maybe scholarships given to a U.S. individual for study abroad. We really want to be looking at the intended use of the funds to determine whether that should be reported on Schedule F. And then thinking about kind of the other side, Schedule I, that's for assistance and grants to domestic organizations and individuals. We really want to be reporting these grants on one or the other, not both. And so with that in mind, it is okay to have foreign addresses on Schedule I, because again, we're looking at the intended use, not necessarily where the money's originally going to initially. And then touching on F-bar. So this is going to be triggered when a foreign financial account exceeds 10,000, and that's at any time during the calendar year. So thinking about that, it's not necessarily only bank accounts that the organization or an individual owns. We need to be thinking about who has signing authority on the accounts. Is there the ability to wire funds? Does the organization own a controlled foreign corporation 100%? And so that's considered control of the account because there's control of the entity. Another thing to note is when one account exceeds $10,000 balance, that creates an F-bar filing for all accounts, even those with zero balances. And then also considering if money happens to get parked in an offshore account before it goes to a foreign entity, that can trigger an F-bar filing as well. And then keeping in mind, this is a calendar year reporting. So even if the organization is operating on a fiscal year, F-bar is calendar, and that also has a different due date. So the F-bar is due October 15th. That is an automatic extension. You don't need to apply for extension from April to get to the October 15th. But keep in mind, for calendar organizations, the 990 is due November 15th. Well, if there's an F-bar filing, that's due before the tax return is due. So keep in mind of that October 15th due date. For the foreign reporting in general, practitioners, what you can be on the lookout for is, program service activities that describe foreign activity, and then looking for foreign addresses of either donors or vendors providing services to the organization. Trying to go through this quickly, guys, bear with me. So there's a lot of information I want to share and just got to go at a high level here. So top 10 things to avoid. And again, this is from a state regulator's perspective. So number one, misleading solicitation. Don't want to mislead your donors in any way. Sometimes it's not intentional. Maybe because of the name of the organization, the donor thinks that they're giving to a different organization. Maybe they're not realizing what their money is going towards. So just want to avoid misleading solicitations in that way. Failure to monitor fundraisers. And the fundraising activities. So that would include employees, volunteers, professional fundraisers that are doing fundraising activities. Number 3, late, missing, incorrect annual filings. So we've touched on those state registrations, knowing the due dates, knowing where you should be registered, knowing the filing fees, what's required, is there an audit needed, and then definitely reviewing those forms before they're submitted. CEO, executive director control, not having too much or sole control of the charity. It's really the board's responsibility to have governance over the organization, and then also evaluating the CEO, hiring, firing, etc. And then number 5, lack of regular board meetings. That's going to go right along into number 6, not keeping board meeting minutes, inadequate documentation, not documenting poor documentation. So moving on to number 7, again, evaluating the CEO's performance, not enforcing or having a lack of internal controls, allowing self-dealing, and then lastly, we want to make sure any restricted gifts are being used towards their restricted purpose. All right. See how I'm doing on time here. Okay, year in review. So this is going to be just high level, some recent issues, things in the news, statistics, resources. And I will note that we are going to be providing the slides, so don't feel like you have to jot all this stuff down. So recent news. You may have heard of these NIL collectives. NIL is name, image, likeness. So what those are doing, they're paying college athletes for their name, image, likeness. And so there are 501c3 organizations already established as these NIL collectives. What happens? The donor gives money to the collectives, they pay out to the athletes. But the question is, where is the exempt purpose in that? So recently in June, this GLAM came out, which is this fun name for a General Legal Advice Memorandum. So you can check that out, GLAM 2023-004. And it's saying that these NIL collectives really don't have an exempt purpose. They shouldn't have 501c3 status because they're, benefiting individuals, and that's not an exempt purpose. Move forward and mention this PGA Live merger. So you can check that out, articles and in the news. And that's just raising concerns about the C6 status after that merger announcement. I do want to mention, you can take a look at Notice 2017-73 about donor advised funds. So it seems like something is going to come out of this. Donor advised funds, there's a push to treat them like private foundations. And what I mean by that is there's a push for these DAFs to distribute like private foundations. And also right now, the recipient organizations are basically avoiding excess contributions by having money received from these DAFs. But the push is that these recipient organizations would need to report the funds as coming from an individual or from something other than a public charity. So that if that goes through, that could hurt some organizations' public support test. Just briefly mention the IRA, energy credits that are out there are not just for-profit organizations. They are available for nonprofits. And then again, on the conservation easements, there's continued focus on that. So just be aware. So statistics, the IRS publishes this data book annually. It's on a fiscal period. So the most recent was ended September 30th, 2022. There were 1.82 million 501c organizations in the US. Of those, 1.48 were C3s. And then the next most common were the C4s. And then it went on from there. Of the 1.82 million organizations, there were 1.75 million tax returns actually filed. Some types of organizations are exempt from filing, so that would make up that difference there. I did take a peek at the book and noticed that 47,000 returns were filed in Michigan, so that was interesting. And I just want to point out, if you take a look at this data book, there's a lot of interesting stuff in there. Criminal investigations, what are the big math errors for, causing notices, or how many of these returns were e-filed versus paper filed, if you want to take a look. So moving forward, in that data book, it was noted that less than 1,500 audits were conducted on these 990s, EZs, and Ns. So I think the number was 1,343, something like that. But that's compared to 9 or 10,000 pre-pandemic. So huge drop there. But I do want to point out, of the audits that are occurring, what we're seeing is focus on insider transactions, underreported or unreported unrelated business income, big focus on employment taxes as far as correct classification of workers, employees versus independent contractor, backup withholding form 8282 I mentioned, and then a focus on C7 social clubs. And then on the state side, for the auditing piece here, different than federal, we're seeing are the laws being followed if there's gaming activity, and then looking at functional expense allocations. So is there fundraising revenue, but no fundraising expense? Or is the organization trying to kind of beef up their program service expenses? Just something to be aware of. And then I do want to point out that communications are getting better with the IRS for the exempt org line in the past few months. There were, just to give you an idea of what we go through on a day-to-day, 30,000 erroneous automatic revocations. So tax exempt status revoked simply because the IRS was not processing timely filed returns in a timely fashion. So they're kicking out those automatic notices when really the return was filed on time. Reminder that e-filing is mandatory. The most recent forms that are available for e-filing were the 990T and the 4720. And then most recently, as of April 3rd, mandatory e-filing for Form 8940. Believe there is a 90-day grace period for that one, but that would have passed by now. So just mention that 990T continues to be updated. So every year that seems to be different for us when we're preparing that. And then resources, and I can provide, there's just 2 slides for this, but the IRS has a lot of good resources. Particularly what was mentioned were these articles that ended in 2004 and some specific phone numbers, particularly for practitioners. Interesting website. If you just Google, where's my application for tax exempt status? Maybe you have one pending. We are looking at a 6 to 8 month turnaround for the 1023s, but recently our firm received a 4-month turnaround. So just note that. And some more resources again, we'll send this out with you. And that's it for me. We got another CPE poll, and Brandy, I'm not sure how long she's been on there because I'm just going at it, but she's
no, it was very, very good, Amber. Thank you so much.
Try to zip through, like post some questions and we'll try to get to you. So
I put a couple things in the chat, just adding that if you have any foreign activities, it's just best to reach out to your tax preparer because you just aren't sure if we have foreign reporting, and there can be some penalties associated, large penalties for not filing those FBARs. So just keep that in mind. And then Amber mentioned gaming and raffle rules. And I just wanted to note that we did a webinar back in May, I think it was, and that is on we had an outside speaker talk about those rules from the Gaming Commission, and that is on our website if you needed to, go back and look at those rules. But now we will turn it over to Jeff if you want to stop sharing, Amber, and we will turn it over to Jeff and on the audit side. Thanks, Jeff.
Give me 1 second here. Is that looking, Brandy, how you want it to look? Or are you seeing?
I see your slides. You'll have to play your slideshow.
Better?
Nope, still just see your slides. There you go. That is perfect.
Okay. A little bit of a off screen for me, but as long as you guys can see what you need to see, we'll get through this. Like Amber, I attended the audit track through the national conference with the AICPA down in DC as well. So she was here to give you a overview on the tax side of things, whereas I'm going to give you a little bit of the hot topics of what's currently going on the audit side of things, or what a nonprofit should be prepared to deal with if they are having audited financials or reviewed financial statements. You can see the couple of topics that I'm going to focus on, leases being the big one. So this has been coming down the road for a few years now. I know we've had a few presentations on it, but it's really important to keep this kind of top of mind because this is a standard that is required to be implemented for calendar years 2022 and fiscal years 2023. So if you're a December year end, you do want to make sure that when you're going through the audit, you have everything taken care of as far as a lease side of things and know what leases you do have and prep for that audit or any year end that's going to happen during the year. The new CECL standard that is coming out, that's a little more forward thinking for us, but we are in the year in which that standard is going to have to be addressed. So 1 year back from the leases, we're looking at calendar years 2023 and then fiscal year ends 2024. But we'll go over that as kind of a update on maybe what we would have considered allowance for bad debt, but it's really intended to look at balance sheet assets that are out there, whether they're trade receivables or loans that might not be at fair market value, they're at cost, and what that true expected asset or receivable is going to be. And then a couple hot topics coming way down the road, and cryptocurrency, and then a little bit of a single audit update just to address some of the issues out there as far as the COVID funding, now that that's kind of wrapping up, and what to expect on the single audit side of things. So leases, like I said, this has been coming down the pipeline for a little bit here. We've had a few deferrals over the years, but we are in the final deferral stage for that. So we are impacting all organizations, so any nonprofits that haven't implemented this already, which pretty much everybody on this call, I would assume, is now implemented for this current year. When we're looking at the transition options, some things changed here a little bit. When the initial standard came out, we were looking at a requirement to have full comparative periods. So you would have had to go back a full year earlier than your year of implementation. That's still an option. You can see that in the top box there where we're looking at that original transition method for ASU 2016-2. What that would be requiring if you were going to go that model would be to do the lease standard implementation for both years and show a full comparative. That is still an option, but ASU 2018-11 did modify this and add in additional transition method. And this is where I think most, if not all, of the nonprofit clients that we're working with are going to probably go. You can continue to use the old model for recording what would have been, I guess, lease activity, but not necessarily lease. So that deferred rent model, if you will, and then just do the new lease standard as of your current year of implementation. So you still have to do that as of 1/1/2022, if that's the beginning of your fiscal year, and implement it for that entire period that we would be auditing or that you're looking at. But you don't need to go back to that comparative year and present it like that as well. So just to give you a little bit of a high level on what we're talking about here. So we've had leases. Historically, we've had finance leases and operating leases. I'll go through those definitions a little bit more as well. But really, we're looking at a right to use asset. And we're looking at payments that would then be paid to a lessor for the right to use that assets. The overall arching piece of the lease standard is to put both of those items on your balance sheet. So we're going to have a right to use asset categorized similar to your fixed assets, and we're going to have some long-term debt related to that right to use asset. And it's going to provide the reader of the financial statements a better picture from a financial statement side of things, not just in the footnote disclosure area, to really show what those long-term payments and what that asset that you're using really consists of. So what is a lease contract? It is that right to use asset, and there has to be a period of time that you can determine, and there has to be an exchange for consideration. That exchange for consideration is what I'm going to say is almost always going to be cash. The requirement of this standard, you can see it right here. Same things I kind of just mentioned, but we are going to now modify your assets and your liabilities to show that right to use asset and that liability for that long-term lease payment as well. Not much to add here, just more or less giving you, especially in the operating lease side of things, we're shifting from more of a footnote disclosure view or presentation to an actual statement of financial position view for these type of assets and liabilities. So once you know you have a lease that we're going to be looking at or assessing as part of the audit, you really have two options. Finance leases, this is going to be very similar to what we would have treated as a capital lease in the past. So think your equipment, think your vehicles that you might be leasing, things of that nature. Operating leases, for the most part, we're thinking renting space within a building, so office space lease, if you will. Both of them are going to have pretty similar impacts on the balance sheet. We're going to be looking at a right to use asset. We're going to be looking at a lease liability, but where those change a little bit is how we're going to be presenting them on your income statement of activities. The intent of a operating lease is really to continue to show the same expense over the term of that operating lease. So we'll see an example in a few slides here where we're looking at, say, $40,000 month or annual payments over the term of this lease. And we want to see a really consistent straight line expense on the operating lease. When you think of the capital lease, you can really compare this to what you might be seeing like on your mortgage. They're very heavy on the interest payments early on. And then as the term of that lease goes on, you're going to see a heavier swing to the principal side of things and less to the interest side of things. So it's just a little bit of a way to think about that, is your finance leases are going to operate a little more like your mortgage, whereas the operating lease, those expenses should be pretty consistent over the term of that lease. So we need to identify that we actually have a lease. Kind of jumped a little bit ahead last time and talking about what we're going to do with a finance and operating lease. But when you are looking at whether or not you have a lease, just be aware that you need to be able to identify a specific asset. It can be a portion of a building. It can be a vehicle. It can be some office equipment, but you have to be able to identify that asset. And then you also need to have control of that asset. If you are not having full control or decision authority over how you're going to use that asset, you really need to look whether or not you have a service arrangement or if you are in a, I guess, lease situation or not. Some examples on what you might see as far as an identified asset. You have a serial number for a copier. You have a VIN number for a vehicle. You can see a set specific floor of a building that you might be leasing, and you have full access and control over that floor of the building that you're accessing. This box to the right, it gives you a little bit of a example of when maybe you do or don't have rights to that building. And the example kind of here is if you don't know the exact area of that building that you are accessing or utilizing, you want to look at whether or not you really do have a lease. If all you're doing is using maybe a portion of that building for storage, but all you do is take the items that you're planning to have stored by the individuals that own that building, and they're storing it anywhere within the building, and you don't have any knowledge of where it's being stored, you don't have any control over it or any access to that, you probably are in a service arrangement situation, not an actual lease. So I don't know how often we're doing that now that paper is kind of going away, but it's an example there that if you don't truly have access and control over that space, then you probably don't have a lease situation. Okay. So this is reiterating the fact that you have to have control. So if it's a shared lease, maybe I heard an example once that if you're a school and you're leasing or using a bus, but because you only need to use that bus during portions of the day and somebody else might be using that bus during other portions of the day, you really have to decide whether or not you do have all of that direct use rights to that asset and whether or not you're using substantially all of the economic benefits of that asset. So overall, I think you're going to be in a situation where it's pretty clear whether or not you do have right to control that asset or not, but just understand that that's part of the decision-making process of whether or not you have both a defined asset and the right to control that asset. Short-term leases. So again, we're looking at the start of a lease term. We're not looking at the date of implementation. We're looking at the start of that lease term. Was it a 12-month or less lease that you entered into? If it was, that's going to be excluded from the standard, and you do not need to account for that as part of the lease because there's no long-term obligation related to that. The one thing I added a note here at the bottom that you would want to consider is whether or not there is a likelihood of extending that arrangement. This, since there's probably no contractual requirement outside of a 1-year agreement, even if there is a lease extension, you would have to be pretty certain that you're going to extend that lease if you are going to pull it into the lease standard and implement it that way, because you don't know. I mean, truthfully, you may make a decision that it's a short-term lease. We think we're going to extend it, but we don't know for sure. And unless you have absolute 100% or close to that, say 90% assurity that you are going to extend it, then I probably wouldn't include it in the standard and implement it as far as an asset and a liability. The one instance would be maybe you are leasing a building. It is a 1-year term, year over year. You've put significant amount of capital into that building for improvements to really make it fit the need that you need it to be. Say you put $1 million into that building, and you did that because you're going to be there for a long time, and you wouldn't have access to that benefit for the amount of money you put into it if you were no longer there. Maybe in that situation, you would have a high likelihood of extending that, and you might want to consider whether or not a lease liability and a right to use asset should be on your books. But then you'd have to determine what you think that reasonable amount of term would be on how long you might extend that, whether that's 30, 40 years, maybe the life of the building. Some contracts have multiple components. So what I'm trying to illustrate here is that you may have a agreement with a party that basically says we are leasing the space. Included in that lease or that contract is also a maintenance service portion as well. And typically you're going to see most organizations separate those. You're going to expense the service side of things, and you're going to put the lease or the principal just for that area, whether it's the space on the books as an asset and a lease liability. There is the option to elect to include it all into one, but just understand you're going to be grossing up the asset and liability on your financial statements for that full contract that includes the service. I don't know if I can recommend one way or another whether or not you want to include it. It would be a simpler calculation just to take the full agreement. But if you had debt covenants for any reason that maybe that additional liability would impact that debt covenant, you may want to consider not going that route. CPE poll 3 is up. All right, so once we have a lease, we have two real options here. We're looking at a finance lease or an operating lease. We have 5 criteria, which I'm going to show on the next slide. If you qualify for any one of those 5 criteria, you are going to be in a finance lease situation. All other leases would be operating lease. And this really is going to come into play when we look at the annual accounting and how you expense and unwind that lease liability. So the 5 criteria are here, again, very similar to a capital lease. Is there an ownership transfer to the lessee at the end of the term? If there is, then we're in a finance lease situation. Does the lessee have a purchase option that can be exercised or reasonably exercised? Then we have a finance lease criteria. The other 2 are a little similar, but number 3, are we using up pretty much all of the economic useful life of that asset? If we are, then again, we're looking at a finance lease. And if the present value of those minimum lease payments is substantially all of the fair value of that lease, then again, we're in a finance lease situation. The last one there, I don't know how often we're going to see this, but it really comes down to an asset that you're leasing that is so specialized for your needs that nobody else really could probably use it. Then we're probably in a finance lease situation as well. But otherwise, they're very similar to what we would have saw in a capital lease determination in previous standards. So initial measurement, typically we're going to see a gross up of the right to use asset and the lease liability of the exact same dollar amount. So when we look at our lease liability, we're going to measure the present value of those future minimum lease payments, and that's going to be our lease liability. When you see on the right of use asset down below, that is a component of your right of use asset. So in the example I'm going to use, we have $179,000. In the example, we have both a gross up of that asset and the liability of the exact same number. Just be aware that if there were other direct expenses that came in, other prepayments or incentives, those have to be factored into that right to use asset as well. And then on the discount rate side of things, so this is the interest that's really being charged on that lease. You have a couple of options. Sometimes it's going to be identified within the agreement. Otherwise, you can use an incremental borrowing rate by talking to your banker, or you may be able to use, or you could also use the risk-free rate and kind of go by that. I know things are changing a lot, but I mean, should be pretty easy to come up with an idea on what a reasonable interest rate on that lease would be. Going to try to speed up here because I know we're running out of time. Finance lease, I know I mentioned it already, but again, we're going to unwind that expense similar to a mortgage, where you're going to be recognizing expenses, interest expense faster in the early years than towards the end of the agreement. And then on a operating lease, the goal would be to have straight line expense that would be recognized as lease or rent expense on your statement of activities. Quick example here, just on how you want to look at the presentation here. You have some options. The first two are acceptable options. The third one is not an acceptable option. I just want to identify that when you're looking at your right to use assets, you have to separate your operating and your finance leases on your statement of financial position. You can, in this middle example, include your finance leases like you have with your capital leases with property, plant, and equipment, but you'd be required to disclose that within your footnotes. And this third option, the attempt here is to show them combined, which is not an acceptable way to show your right to use assets. You have to break them out. I've got a quick example here that I'm just going to run through, but I don't want to spend too much time because I want to hit on the CECL topic as well. You can see the terms that we're entering here, but overall, you can see we're booking that right to use asset of $179,000 and a offsetting liability for that $179,000. This table here shows the ultimate journal entries that are going to be recorded on your statement of activities as you wind down the finance lease. You can see we started with the $179,000. We made a $40,000 payment. A portion of that $40,000 payment is going to reduce your liability, and you can see the other portion of that is going to go to interest expense. That's going to wind down the liability. Then on the asset side of things, you start with your $179,000, but we have our straight line amortization of that asset. And again, as we take that over the term of that lease agreement, we're going to unwind the $179,000. And ultimately, at the end of that 6 years, we'll account for all $240,000 of the expense that was paid out. This is the journal entries that would have happened with the year-end balances if that example was a finance lease. I also have the exact same terms, but we determined that this one is an operating lease. And just for example, to jump right to that same slide on how we unwind the asset and liability here, and you can see that right here. So we have $40,000 payments. We're going to recognize that $40,000 of expense, but then we're going to unwind the asset and liability at a different rate, if you will, based on the straight line amortization of those payments. So essentially, this is going to be the reduction that we had here between these payments. So it's just slightly different. The intent is to have a straight line expense for that full $240,000 run through the P&L on an operating lease, so it's smoothed, versus a finance lease that would represent a little more of a picture that you would see through a mortgage. Here's the comparison of what those journal entries would look for the same information based on a finance or an operating lease. I'm going to jump through this one. It's a similar example. It just had escalating payments where you paid more towards the end of the lease than you did at the beginning on those payments. So CECL, again, I mentioned this. This is our credit loss standard. Again, we're looking at it similar to what we would have had with an allowance on some of those assets that you would have on your balance sheet. It replaces the incurred loss methodology. So a lot of universities or financial organizations would have used the incurred loss, where once it was probable that a loss was going to incur, they would then write off that portion of the receivable or loan that was out there. Now we're going to be looking at a combination of historical experience, current conditions, and reasonable or supportable forecasts, and how to come up with a credit loss estimate that you would reduce that on an ongoing basis. I do want to emphasize that this does not apply to promises to give. So if you're primarily a contribution or donation-based organization, this does not qualify to do any of this. I mean, no credit is being given, so there's no reason to be looking at the standard for those situations. Again, we talked about the effective date already. It's coming in for this current fiscal year, 12/31 year end, 2023. And there is a modified retrospective approach, which essentially means you have to have a prior period adjustment if you need to implement this standard. So as of 1/1/2022, we'd have to have that calculation and do a prior period adjustment for that. What's really the switch here? So there was some limitations when it came to the previous way the standard was. We weren't looking at losses until they were probable. So there was a situation of maybe we had an overstatement of assets, and there were some users of these financial statements that would say, okay, we have these loans out here. We're going to assume they're not fully collectible and maybe make their own assumptions. So there's a need that the FASB really decided that there had to be a change. And this provides a little more forecasting or forward looking, which is a little bit different, a little bit uncomfortable from an auditor side of things. I get that. So a couple of quick things here. This is still going to be an allowance valuation type account, similar to what we would have had with an allowance for bad debts. Again, if we write some off from a asset at cost, you can see that in point 3, where we could have recoveries. Maybe we determine that something wasn't going to be received. We wrote it off, but then we turn around in a future year and we think we're now going to receive that. Recoveries can't exceed any amounts that were previously written off. Quick update there. CPE poll number 4 just popped up. And sorry, I do realize that I'm going really, really quick here. I know we only have about 5 minutes left. So what does this apply to? Really any financial assets that aren't measured at fair value. So again, we're looking at loans, we're looking at financial receivables, we're looking at receivables under topic 606. So if you have membership dues, they technically would qualify under this. Maybe you don't have a huge adjustment that's going to happen when you're looking at those type of assets, but it is something you'd have to consider. What's being scoped out, this is probably a little easier to explain, but again, I mentioned it, but any of those contributions, promises to give, pledges receivable, grants receivable, those are largely not going to be applicable under the standard, and you don't need to have any allowance related to them. And the reason for that is they're donations. The people giving those donations aren't receiving any sort of credit on behalf of those donations, so there's no exposure related to that. Financial assets measured at fair value. So if you have an asset measured at fair value, that's also going to be excluded. Those are the two items that are going to impact organizations, nonprofits the most. A couple of definitions on a financial asset and a financing receivable. I'm not really going to spend much time on this, but essentially, if you are giving credit to an organization for some sort of item in return, then we do have what we'd call a financial asset. That could be a loan, that could be trade receivables, that could be those membership receivables as well. Handful of organization or examples here: loans, trade receivables, all those items that I just mentioned. And again, you will have these slides. So even though I'm going fast, hopefully you're not going to miss out on too much. Main provisions, again, similar to what we're already looking at when it comes to bad debt expense, but we're looking at it from a little bit more of a, like, how actual is that asset to be received, and what is the real impairment of that asset that we should be writing that asset down for. So we're going to use the same factors I said: historical, current conditions, and reasonable supportable forecasts. I have a quick example after this slide that I want to run through just so you have a good idea on what we're really looking at. But trade accounts receivable, I threw this in here just so that organizations know that trade accounts receivable would still be subject to it. And even though not much will probably change in how you're assessing that allowance, it does require that you do a little bit of current and future analysis of those accounts receivable. The example I have here is on a higher education one. As we know, a lot of universities, colleges, they give out loans to their students. In this example, you can see what their past due percentages were on what they would have maybe written off or not received. Very high towards the greater than 90 days out, and very small when it comes to those very current or 1 to 30 days out. And this is probably typical to how historically that percentage or that calculation might have happened. The one caveat that we're switching here now is looking at what the current economic condition might look like, what we think we're going to receive. And you can see here, they made the assessment that we're going to decrease that credit loss expectation or historical expectation by 10% to come up with a new credit loss. So these percentages in the middle column are all just reduced by 10%. So the 73.8 is 90% of the 82, so on and so forth. And we're applying that to the outstanding loan balances and coming up with what that overall expected credit loss estimate would be. So again, not trying to make this more complicated than it needs, just something to be aware of as you go through this year, if you think the credit loss standard is going to impact you. A couple of things to do right now. Just go out and look at the standard ASU 2013 16-13, look at what methodology you might want to use to calculate that, and really reach out to your auditors to see what you think this might have from an impact on your organization, and possibly develop some policy and procedures. The last two items that I want to do at a very high level and go through quick is the FASB does look at upcoming issues that might be impacting organizations. This is a snip right out of the FASB's current agenda consultation that's over, but they had an invitation to comment on that. The largest, most requested comment coming in was digital assets. So we're thinking cryptocurrencies here. And as you go through here, I do have some issues that were identified through that invitation to comment. And they are in the current exposure draft spot with the cryptocurrencies. And the point here is that any organization that had crypto assets, the thought was that they weren't really being valued on the balance sheet correctly. And now we're trying to implement standards that will help address these and have a fair market value measurement for that cryptocurrency. So you can go through here and just see this is still off on the horizon. So don't worry too much about any immediate impact on this, but just be aware that it is coming down. And if you have a single audit, there's a little bit of information within the slide deck that also shows which programs are higher risk and how they're going to be treated and the likelihood that they probably will. Your auditor will be testing that again if they've tested it in the past and it's still a type A program. And the final piece I had for you just had to do with the federal audit clearinghouse transition. So effective October 1st, 2023, we are going to be moving to a new system to file our data collection form. So that was the last piece I had. All that information's in there towards the end. I know I went fast, but reach out to Amber, myself, Brandy at any point if you have any questions. And again, apologize for running just a tad over.
I just had one question that came through, Jeff, real quick. Question was, what if you don't have a rent agreement on a truck that they use, but they do rent the truck weekly? Do they have to include it? This was back with the leases.
Yeah, I would say you don't have a lease situation there. We're looking for true legal requirements on those future liabilities that your organization would owe. So I'd say no, that's not a lease type situation.
Great, thank you. And thank you, Amber and Jeff. Thank you, everyone, for joining us today. Tomorrow, we will be emailing out a recording of this presentation along with a copy of the slides, and you should be looking for your CPE certificate that will come shortly too. Our contact information will also be in that email. So like Jeff said, if you have any additional questions, feel free to reach out. Next month, we will be talking about reporting new revenue streams. We will be talking about the correct classification of revenue for tax purposes, along with some best practices on how to monitor and record that revenue. So please keep your eyes peeled for that communications regarding that webinar. And I hope you have a great rest of your day. And thank you again.